You are looking at a number on your screen right now that says $63.21, a number that represents a 2% gain in a single trading session. But if you think this is just another green candle on a chart, you are missing the single most important financial signal of the last decade, because what happened today isn't just price action. It is a structural failure of the suppression mechanism that has held silver down for 40 years, and vindication for every single person who stacked ounces when the world told them it was a dead rock. We need to have a very serious conversation about why 63.21 is the point of no return, because unlike the speculative bubbles we saw in crypto or tech stocks where the price was driven by hype and hope, this move is being driven by a physical reality that the COMEX and the London Bullion Market Association can no longer hide, which is that the vaults are running on empty at the exact moment that industrial demand is hitting a vertical slope. You have to look at the order flow that came in this morning. Because retail investors don't buy millions of ounces in a matter of minutes to push the price up 2% in a controlled fashion. That was institutional panic buying. That was a major industrial user or a sovereign entity realizing that if they don't secure their metal at $63, they might have to pay $80 or $100 next month. Think about the solar panel industry, which we have discussed before, but now we have the hard data proving that newer photovoltaic technologies are using 30 to 50% more silver per panel than they were just 3 years ago. And when you multiply that by the exponential growth of green energy mandates globally, you realize that the mining sector is running a deficit of hundreds of millions of ounces every single year. This deficit used to be filled by above-ground stockpiles, but today's price action tells us that those stockpiles are effectively gone, or at least they are in strong hands that are not selling at $63, and that creates a liquidity squeeze that is terrifying for the short sellers. I want you to picture the commercial banks who have been naked shorting silver, selling paper contracts representing metal that doesn't exist. They have been playing a game of musical chairs for decades, relying on the fact that investors would never demand delivery of the physical metal. But today, at 63.21, the music has stopped and there are no chairs left. When the price rises this aggressively in the face of a strong dollar or rising yields, it means the correlation algorithms have broken. It means silver is no longer trading as a currency derivative, but as a strategic critical mineral that is becoming as essential as oil. We also need to talk about the psychological aspect of this, because for years, silver investors have suffered through what we call the wall of worry, watching prices get smashed down every time they tried to rally, creating a conditioned response where you expect the price to crash after a gain. But look at the chart today. Look at the volume profile. There was no smash. There was no rejection. The sellers stepped in and were immediately absorbed by a wall of buying pressure, which indicates a complete change in market character. This is what a true bull market looks like. It climbs a wall of worry until it enters the euphoria phase, and we aren't even in the euphoria phase yet. We are in the disbelief phase, where the mainstream media is barely covering this because they don't understand it, but you do. You understand that the purchasing power of the fiat currency in your pocket is evaporating, and that $63 today is historically cheap when you adjust for real inflation since 1980 or 2011. In fact, if you use the shadow government statistics for inflation, silver should arguably be trading closer to $300 just to match its previous purchasing power parity. This gives us a massive asymmetrical risk-to-reward ratio, because the downside is limited by the production cost. Miners can barely pull this stuff out of the ground profitably at lower levels due to rising energy and labor costs, while the upside is virtually unlimited because it is a tiny market. If just 1% of the capital currently sitting in the S&P 500 or the bond market decides to hedge against inflation by moving into silver, the price wouldn't just go to $100, it would gap up in overnight trading and leave everyone on the sidelines behind. We are seeing the early signs of that rotation now, and it's critical that you don't let the volatility shake you out, because the bullion banks are going to try one last desperate attempt to flush out the weak hands. They will try to trigger your stop losses. They will release bearish reports. But you have to look at the physical truth. You cannot print silver. You can print dollars, you can print euros, you can print yen until the paper is worthless, but you have to dig silver out of the earth, refine it, and transport it. And right now, the earth is not giving up enough of it to satisfy the hunger of the technology sector and the monetary investors simultaneously. This is the perfect storm that we predicted. And seeing it play out at 63.21 is not the end. It is the confirmation signal that the breakout is real. Let's talk about the mining supply for a second, because people assume that higher prices will instantly bring more supply online, but that is a lie because it takes 10 years to permit, build, and ramp up a new silver mine. So even if silver went to $100 tomorrow, there's no supply response coming to save the shorts for at least a decade. We are stuck in a structural deficit. That price is the only mechanism to solve, meaning the price must go high enough to destroy demand. But here's the catch. You can't destroy demand in the electronics or solar sectors because silver is the most conductive metal on the periodic table and there is no substitute. So industry will pay whatever price is necessary, whether that's $70, $100 or more, because silver is a tiny fraction of the cost of a solar panel or an electric vehicle. But without it, the product doesn't work. This inelastic demand is the rocket fuel for the price. Now, combine that with the monetary demand from India and China, where the populations understand real money better than the West does, and we are seeing record import numbers into Shanghai and Mumbai, draining the Western vaults and moving the center of gravity for pricing from New York and London to the east. The silver squeeze that everyone talked about on social media a few years ago wasn't a failure. It was just early. And in markets, being early is indistinguishable from being wrong until the moment you are right. And today, at 63.21, you are right. We are also looking at the geopolitical angle, where nations are stockpiling commodities to protect themselves against sanctions and currency weaponization, and silver is the poor man's gold, the accessible wealth storage for the masses. And as gold becomes too expensive for the average person, silver becomes the logical alternative, creating a secondary wave of demand that we haven't even fully priced in yet. I want to address the skeptics who say we've been here before, because we haven't. In 2011, the rally was driven largely by speculation. Today, the rally is driven by the fact that we are literally running out of accessible silver above ground. The exchanges are bleeding inventory. The registered category at the COMEX, which is the metal available for immediate delivery, has plummeted to levels that make the market incredibly fragile. A single large entity standing for delivery could break the price mechanism, and maybe that's what we are seeing today. Maybe a whale decided they want the metal, not the paper. As we close in on the next psychological target of $65 and then $70, the volatility will increase, the swings will get wilder, but the trend is undeniable. You are witnessing the revaluation of a monetary metal in real time. Do not get distracted by the noise. Do not let them scare you out of your position just before the payoff, because the fundamentals are screaming that 63.21 is just the launch pad. This is about wealth preservation, it is about mathematical certainty, and it is about having the courage to sit tight when the rest of the world is panic buying what you already own. Stay focused on the data, ignore the noise, and watch closely what happens at the $65 level, because once that breaks, there's very little resistance left on the chart until we challenge the all-time highs. This is history in the making, and you are part of it.